$38 trillion. That's America's national debt right now, not projected, not estimated. The actual number is sitting on the Treasury Department's books. And here's the part that should get your attention. We added the last trillion in just 2 months. August to October, the fastest accumulation outside of a global pandemic. The pace we're on now is twice as fast as the rate of growth since 2000. $70,000 per second. That's how fast this number climbs. Every single second you watch this video, another $70,000 gets added to a debt that already equals the entire annual output of the American economy. But this isn't a video about scary numbers. Numbers without context are just noise. This is about a pattern that's repeated 3 times over the last 500 years. 3 global superpowers, 3 reserve currencies, same warning signs, same sequence of events, same outcome. Spain in the 1500s, the Dutch Republic in the 1600s, the British Empire in the 1900s. Each one dominated global finance. Each one's currency was the standard for international trade, and each one collapsed following an identical 4-stage cycle that took decades to build and months to unravel. The largest financial institutions in the world are already moving. China has cut its treasury holdings by 47% from their peak. Foreign central banks are accumulating gold at rates not seen in decades. Entire payment systems are being built specifically to bypass the dollar. This isn't speculation, it's documented capital flow. Treasury data, IMF reports, numbers you can verify yourself before this video ends. The question isn't whether this pattern exists. The question is what stage we're in right now. And by the end of this video, you'll know exactly where we stand and what typically comes next. Because the people who saw Spain's collapse coming moved their wealth to Amsterdam. The people who saw Amsterdam's collapse coming moved to London. The people who saw London's collapse coming moved to New York. The pattern doesn't care about military power. It doesn't care about technology. It doesn't care about exceptionalism. It just unfolds the same way every time. And the only difference between those who preserved their wealth through these transitions and those who lost everything? Information. Recognizing the pattern before it completed. Let's start with the numbers. Let's put real numbers on this. As of December 2025, total gross national debt stands at $38.4 trillion. So that's $2.23 trillion higher than 1 year ago. $11 trillion higher than 5 years ago. Break that down further. The debt increases $6.12 billion every single day. $255 million every hour, $4.25 million every minute. What does $38.4 trillion actually mean for you personally? According to the Joint Economic Committee, that's $112,881 per person, $284,914 per household. Every man, woman, and child in America owes that much on paper before they pay a single bill of their own. But here's where it gets serious. Debt held by the public just crossed 100% of GDP for the first time outside of World War II. The entire annual economic output of the United States now equals what we owe. Everything Americans produce in a year, every car manufactured, every surgery performed, every meal served, every line of code written, all of it together just matches the debt. And servicing that debt is eating us alive. In fiscal year 2025, the federal government paid $970 billion just in interest. Not paying down the debt, just interest. That's nearly triple what we paid 5 years ago when interest costs were $345 billion. The Congressional Budget Office confirms that actual interest payments on public debt crossed $1 trillion for the first time in FY 2025. Interest is now the 3rd largest line item in the entire federal budget, bigger than Medicare, bigger than national defense. Think about that. We now spend more money paying interest to bondholders than we spend defending the country. And this is just the beginning. CBO Project's interest payments will hit $1.8 trillion annually by 2035. We spent $4 trillion on interest over the last decade. We'll spend $14 trillion over the next decade. Interest costs are the fastest growing part of the federal budget. Now zoom out globally. According to the IMF's Global Debt Database updated in September 2025, total world debt stands at $251 trillion. That's 235% of global GDP. Public debt alone hit $99.2 trillion. The United States and China together account for over half of the world's total government debt. But America's situation stands out. Our debt to GDP ratio is 125%. Japan is higher at 230%, but Japan holds most of its debt domestically. America depends on foreign buyers. And that's where the pattern begins to show itself. Because throughout history, empires didn't collapse from debt alone. They collapsed when the people lending them money started looking for the exit, when creditors began quietly moving their wealth elsewhere, when confidence cracked. $34 trillion in January 2024, $35 trillion in July, $36 trillion in November, $37 trillion in August 2025, $38 trillion in October, $4 trillion added in under 2 years. At this pace, we'll hit $39 trillion by March 2026. The numbers are accelerating. The interest payments are compounding. The question every serious investor is asking isn't whether the math works. It doesn't. The question is how long before the rest of the world figures that out. This exact situation has played out before, 3 times, and every single time it followed the same 4 stages. Let me show you how it works. Every major reserve currency collapse in the last 500 years followed the same sequence. Not similar, identical. 4 stages, same order, same warning signs, same result. Once you understand this pattern, you'll start seeing it everywhere. In the headlines, in the treasury data, in the moves that major institutions are making right now. Stage 1, the ascension. A nation becomes the center of global finance. It happens through some combination of military victory, trade dominance, and innovation. Capital floods in from everywhere because that's where the opportunities are. The currency becomes the standard for international transactions. If you want to do business globally, you need their money. Banks expand, markets boom, innovation accelerates. The future looks limitless. Everyone wants exposure to this economy. Foreign governments hold reserves in this currency because it's the safest place to park wealth. Confidence is absolute. This stage typically lasts 50 to 80 years. Stage 2, the overextension. Success creates complacency. The government starts spending beyond its means. Military expansion, foreign interventions, domestic programs, all funded with borrowed money. The math stops working, but nobody notices because asset prices keep rising. Real estate booms, stock markets hit records. Everyone feels wealthy on paper. When problems appear, the central authority prints money or debases the currency to keep things going. Debt grows faster than the economy. Interest payments consume a larger share of revenue each year. But the world still trusts the currency, so borrowing remains cheap. The warning signs are visible in the ledgers, but the prosperity feels real. So people ignore the ledgers. This stage lasts 20 to 40 years. Stage 3, the silent exodus. This is the critical phase, the one most people miss entirely. The smart money sees what's coming. Not the public, not the politicians, not the media, just the institutions and families who actually read balance sheets. Major foreign holders start reducing their positions, not dramatically, not with announcements, quietly, systematically. They diversify into other currencies. They buy gold. They build alternative systems. They move wealth to jurisdictions that aren't tied to the declining power. There's no single moment when this starts. It's a gradual shift that accelerates over time. The public doesn't notice because the currency still functions. Prices still get quoted in it. Trade still settles in it. But underneath, the foundation is eroding. Capital doesn't flee, it rotates. The outflows are orderly enough that they don't make headlines. But the trend is clear to anyone watching the data. This stage lasts 18 to 36 months. Stage 4, the collapse. The exodus reaches a tipping point. Confidence breaks. Foreign central banks accelerate their selling. The currency loses reserve status, not overnight, but faster than anyone expected once it starts. Inflation spikes because all those currency units held overseas come flooding home. Interest rates surge because the government has to offer higher yields to attract buyers. Asset prices crash. Stocks, bonds, real estate. Everything deflates simultaneously. Banks fail. Pensions evaporate. The middle class gets destroyed. Wealth accumulated over generations disappears in months. Political chaos follows. And everyone asks the same question they've asked after every collapse in history. How did we not see this coming? The answer is always the same. The signs were there. The pattern was visible. The data was public. People just didn't want to believe it until it was too late. 4 stages, 500 years, 3 reserve currencies. Let me prove this pattern is real. Starting with the first modern superpower to follow it, the Spanish Empire, the 1500s. Spain, the most powerful empire on earth. No debate, no competition. Spanish conquistadors had just conquered the Aztec and Incan empires. Galleons returned from the Americas loaded with more gold and silver than Europe had ever seen. The mines at Potosi in Peru alone produced wealth that seemed inexhaustible. The Spanish real was the global reserve currency. If you wanted to trade internationally, you needed reals. Madrid was the financial center of the known world. Spanish armies were considered invincible. The empire stretched across Europe, the Americas, Asia, and Africa. King Philip II ruled territories so vast that it was said the sun never set on the Spanish flag. Stage 1, complete. Then came the wars, always the wars. Philip II was fighting a war every single year of his reign. Against France, against England, against the Ottoman Empire, against Dutch rebels in the Netherlands. Military expenditures consumed more than 60% of the crown's spending. The gold and silver kept flowing from the New World, so Philip kept borrowing. German bankers, Italian bankers, anyone who would lend. The crown's debts grew larger than any sovereign had ever accumulated. By 1543, 65% of all tax revenue went just to pay interest on existing debt. not the debt itself, just the interest. Interest rates on Spanish government loans climbed from 17% to 48% as lenders demanded more compensation for the growing risk. The math was breaking, but silver kept arriving, so everyone pretended the math still worked. Stage 2, verified. Then something shifted, quietly. The 1550s, major banking families started repositioning. The Fuggers, Spain's biggest creditors, began demanding repayment in gold instead of promises. They wanted out. Genoese bankers who had financed the crown for decades started moving operations. Wealthy merchants transferred assets northward, not all at once, gradually, opening offices in Amsterdam, redirecting trade routes, building relationships outside Spanish control. Why? Because they could read the ledgers. And the ledger said Spain was functionally bankrupt despite all that silver flowing in. Stage 3, documented. 1557, Philip II defaulted on the crown's debts. The first time. Credit markets froze. Spanish bonds became worthless overnight. The government seized private gold shipments to pay soldiers. Chaos spread through the financial system. But the king promised it was temporary. A one-time adjustment. Everything would return to normal. 1560, Spain defaulted again. 1575, again. 1596, again. 4 defaults in 40 years under a single king. Philip II became the first serial defaulter in history. Spain would eventually default 13 times total, the record holder for sovereign bankruptcies. The currency collapsed. Inflation destroyed purchasing power. The government tried issuing debased copper coinage called vellon, which only accelerated the crisis. By 1607, Spain declared yet another moratorium on debts. The middle class had been wiped out. The productive merchant class had fled or converted their wealth into tax-exempt nobility status. Spanish industry collapsed. Foreign traders, mostly Dutch and German, ran what remained of Spain's commerce. At Cadiz, one of Spain's primary ports, only 12 of 84 commercial houses were actually Spanish by the early 1600s. Foreigners controlled the trade in Spain's own cities. The empire that had seemed invincible crumbled in less than 50 years. The Golden Age ended. It never came back. Stage 4, complete. Where did all that smart money go? North, to the Dutch Republic. Amsterdam became the new center of global finance. The guilder replaced the real as the currency of international trade. The pattern continued with the next superpower. Which brings us to example 2, the 1600s. Amsterdam, the richest city in the world by every measure. The Dutch had just won their independence from Spain after 80 years of war. And they didn't just survive. They built something entirely new. The Dutch East India Company, founded in 1602, became the first publicly traded corporation in history. At its peak, it was worth the equivalent of $8.28 trillion in today's money. More than Apple, Microsoft, Amazon, and Google combined. Then doubled. The Amsterdam Stock Exchange was the first formal stock market ever created. The Bank of Amsterdam, established in 1609, became the model for modern central banking. Deposits grew from just under 1 million guilders in 1611 to over 16 million by 1700. The Dutch guilder was the global reserve currency. International trade required guilders. Foreign governments held their reserves in Amsterdam. The city became the hub where the world's money flowed. The Dutch invented capitalism as we know it. Public debt markets, equity markets, options trading, futures contracts, insurance products. Financial instruments that wouldn't appear elsewhere for another century originated in Amsterdam. A small nation with fewer people than modern Houston dominated global trade, controlled shipping routes from Indonesia to Brazil to South Africa, and accumulated wealth that dwarfed larger empires. Stage 1, undeniable. Then came the wars. 3 Anglo-Dutch wars between 1652 and 1674. Wars with France. Wars with Spain. Wars to protect their trading posts scattered across 3 continents. The Dutch military presence stretched from the East Indies to the Caribbean to the Cape of Good Hope. Every outpost required defense. Every trade route needed protection. And all of it cost money. Public debt exploded. Between 1688 and 1713, the Dutch added 200 million guilders in debt fighting the 9 Years' War and the War of Spanish Succession. By the 18th century, 70% of Holland's annual revenue went to debt service, not investment, not defense, just paying interest on past borrowing. The Bank of Amsterdam, supposedly the safest institution in Europe, began secretly lending depositor funds to finance government operations. They ran what we'd now call fractional reserve banking before the term existed, a Ponzi structure dressed in legitimacy. Meanwhile, speculation ran wild. Tulip mania had already demonstrated how detached Dutch asset prices could become from reality. A single rare tulip bulb once sold for more than 10 times an artisan's annual income. The fundamentals were deteriorating, but the money kept flowing in because Amsterdam was still where the world did business. Stage 2, check, the 1690s. The smart money started moving. Major banking families transferred operations to London. Sephardic Jewish merchants who had made Amsterdam wealthy began relocating. Portuguese traders opened offices in England. German financiers quietly pulled capital out. Not dramatically, systematically, over years. The inflows that had built Amsterdam reversed direction. The city remained functional. Trade continued, but the trajectory had changed. Capital that once accumulated now gradually drained toward the rising power across the North Sea. By the mid-1700s, the Dutch were lending their accumulated wealth to foreign governments. Because domestic investment opportunities had dried up, Amsterdam became a creditor to the world, including loans to the young American Republic during its revolution. But lending your savings abroad is very different from attracting investment at home. The Dutch financial system was living on past wealth rather than generating new prosperity. Stage 3, verified. The Fourth Anglo-Dutch War delivered the final blow. Fought between 1780 and 1784, partly because the Dutch had supported American independence, the British won decisively. The war bankrupted what remained of Dutch finances and exposed how far the empire had declined. Then came the French Revolution and its wars. In 1795, French revolutionary armies invaded. The Dutch Republic fell. The Bank of Amsterdam's decades of secret lending were exposed. Depositors discovered their money was gone. The guilder collapsed. The indemnity France imposed drove the country into deep fiscal crisis. Inflation and unemployment devastated the population. The Bank of Amsterdam, the institution that had anchored global finance for nearly 2 centuries, ceased to exist. The Dutch Golden Age ended. 150 years of dominance, gone in months once the final stage began. Stage 4, complete. Where did the capital go? Across the Channel. To London. Britain was next. The pound sterling became the new global reserve currency. The city of London replaced Amsterdam as the world's financial center. The cycle continued. Which brings us to example 3. And this one matters most because it's the closest to our current situation. The British Empire, the most recent example. The closest parallel to where America stands today. At its peak, Britain controlled 23% of the world's population, a quarter of Earth's landmass. The phrase everyone knew, the sun never sets, on the British flag. The pound sterling was the global reserve currency for over 200 years, longer than any currency in modern history. Over 60% of international trade settled in pounds. The gold standard itself was built around sterling. London was the undisputed center of global finance. Need capital for railroads in America? You went to London. Mines in Africa? London. Plantations in Asia? London. Infrastructure on any continent? London. British banks financed the world's development. The city of London invented financial products that spread across the globe. £1 bought $5 at the start of the 20th century. Sterling wasn't just strong. It was the foundation everything else was measured against. Stage 1, absolute. Then came the 20th century, and 2 catastrophic wars. World War I cost Britain the equivalent of over $600 billion in today's money. Britain tried to stay on the gold standard after the war. Failed in 1931. The system was breaking under the weight of accumulated obligations. World War II made everything worse. Britain borrowed massively from the United States just to survive. Lend-Lease kept the country fighting, but the bills came due. By 1945, Britain had accumulated $21 billion in total debt. That was equivalent to over 75,000 metric tons of gold at the time, more than 2.5 times the combined gold reserves of every country on Earth. It was a sum that could never be repaid without devaluation. Sterling liabilities stood at $3.7 billion. British gold and dollar reserves totaled just $620 million. The math was obvious to anyone who looked. 6. Britain entered World War II as one of the world's great powers. It emerged technically victorious, but financially destroyed. The world's largest creditor had become the world's largest debtor. Stage 2, check. The late 1940s. The exodus began. European countries moved first. By 1952, sterling accounted for less than 10% of Western European central bank reserves. The shift away from the pound happened within 7 years of the war ending. Major British corporations started redirecting investment. Unilever, Shell, British Petroleum, not abandoning Britain entirely, just building elsewhere, shifting capital to where growth was happening. Wealthy British families transferred assets overseas, to Switzerland, to America, to Canada, anywhere with lower taxes and better prospects than declining, debt-burdened Britain. The brain drain accelerated through the 1950s and 1960s. Scientists, engineers, entrepreneurs, the talent that had powered British innovation left for opportunities in America. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The money was leaving, the talent was leaving, the future was leaving. Britain still had its Commonwealth, its sterling area where former colonies kept reserves in pounds, but those countries stayed partly because British authorities used diplomatic pressure, trade threats, and exchange controls to prevent them from leaving. When countries did manage to exit the sterling area, they immediately rebalanced their reserves away from pounds. The preference for sterling was institutional inertia, not confidence. Stage 3, check. November 1967, the pound devalued 14.3% overnight. One day, you wake up. Your currency buys 14% less than it did yesterday. The government had no choice. They'd exhausted foreign currency reserves trying to defend an exchange rate the market no longer believed in. Prime Minister Harold Wilson went on television to reassure the public that the pound in your pocket hadn't been devalued. It was technically true and completely misleading. Import prices immediately rose. Inflation followed. But 1967 wasn't the end. It was a symptom. 1949 had seen an even larger devaluation, 30% overnight. The pound dropped from $4.03 to $2.80 in a single announcement. Savings lost nearly a third of their international purchasing power between sunset and sunrise. Then came 1976, the final humiliation. Britain, the former global superpower, the empire on which the sun never set, went to the International Monetary Fund for an emergency bailout. Like a developing nation, begging for loans to keep the government functioning, the IMF imposed conditions, spending cuts, policy changes. Britain had to accept terms dictated by an international body just to stay solvent. The pound lost its reserve currency status. International trade shifted to dollars. The Bretton Woods system had already made the dollar central, but Britain's collapse cemented American dominance. £1 had bought $5 in 1900. By the 1970s, it bought less than $2. Today, it buys around $1.25, a 75% decline in relative value over a century. Stage 4, verified, 3 empires. 3 reserve currencies. 500 years of history, same 4-stage pattern, same sequence of events, same outcome. Spain dominated the 1500s, collapsed. The Dutch dominated the 1600s and 1700s, collapsed. Britain dominated the 1800s and early 1900s, collapsed. Each time the warning signs were visible decades in advance. Each time the smart money left before the final stage. Each time the public was caught off guard when confidence finally broke. Now let me show you why America is in stage 3 right now. 1944. Bretton Woods, New Hampshire. 44 nations agreed to rebuild the global financial system after World War II. The US dollar, backed by gold at $35 per ounce, became the world's reserve currency. Other currencies would be pegged to the dollar. The dollar would be pegged to gold. America had won the war. Europe and Asia lay in ruins. The United States held 2/3 of the world's gold reserves and produced half of global economic output. The capital flooded in. American markets became the deepest and most liquid on earth. Everyone wanted U.S. assets, stocks, bonds, real estate, treasury securities. The American century began. Stage 1, complete, August 15th, 1971. President Nixon ended gold convertibility. The dollar became pure fiat currency. No gold backing, no commodity anchor, just faith in the U.S. government, just trust. And what happens when you remove all limits on a government's ability to borrow? 1980, national debt, $900 billion. 1990, $3 trillion, 2000, $5.6 trillion, 2008, $10 trillion, 2020, $27 trillion, January 2024, $34 trillion, July 2024, $35 trillion. November 2024, $36 trillion. August 2025, $37 trillion. October 2025, $38 trillion, a 4,200% increase since 1980. The debt more than doubled in just 5 years. We're adding $1 trillion every few months now. Interest payments nearly tripled in 5 years, from $345 billion in 2020 to $970 billion in 2025. We crossed $1 trillion in annual interest for the first time in history, more than we spend on national defense, and that's just federal debt. Add corporate debt at $13.5 trillion, household debt at $18 trillion, student loans, credit cards, auto loans. Total U.S. debt exceeds $100 trillion, over 370% of GDP. For context, Spain started defaulting at around 200% debt to GDP. The Dutch Republic collapsed at roughly 250%. Britain lost reserve status at 130%. America is at 370%. And climbing. Stage 2, verified, mathematical. Now here's where it gets serious. Look at what foreign holders of U.S. debt are doing. Not what they're saying, what they're actually doing with their money. China held over $1.3 trillion in U.S. treasuries at the peak in November 2013. The largest foreign holder of American debt, October 2025, $688.7 billion. That's a 47% reduction. China has sold over $600 billion in U.S. government bonds over the past decade. Their current holdings are the lowest since November 2008. This isn't a blip, it's a trend, month after month, year after year. Exposed to fewer and fewer US dollars. China is no longer even the second largest foreign holder of treasuries. They fall into third place. The United Kingdom passed them in March 2025. Japan remains the largest foreign holder at $1.2 trillion. But Japanese investors have been net sellers of long-dated treasuries through 2025. They're shortening duration, reducing exposure to long-term American promises. Total foreign holdings dipped to $9.24 trillion in October 2025. The flows that used to automatically absorb American debt issuance are weakening, so who's buying? Increasingly, America itself, the Federal Reserve, government pension funds, domestic institutions that have limited alternatives, circular financing, printing money to buy your own debt. That's not strength. That's the financial equivalent of a snake eating its own tail. And it's not just governments repositioning. Central banks globally have been accumulating gold at the fastest pace in decades. According to the World Gold Council, central bank gold purchases in 2022 and 2023 reached levels not seen in over 50 years. BRICS nations now control an estimated 50% of global gold production. Why buy gold? Because gold can't be printed, can't be sanctioned, can't be frozen in someone else's banking system. It's a hedge against exactly the scenario the historical pattern predicts. The smart money is moving, quietly, systematically, without announcements, just like the Genoese bankers who started demanding gold from Spain in the 1550s, just like the Dutch merchants who opened offices in London in the 1690s, just like the British families who transferred assets to America in the 1940s and 1950s. The pattern repeats because the incentives are identical. When debt becomes unsustainable, those who see it first protect themselves first. They don't wait for confirmation. They don't wait for consensus. They act while everyone else is still debating whether there's a problem. The timeline for stage 3 historically runs 18 to 36 months. Based on when foreign selling accelerated and gold accumulation intensified, we're likely 12 to 18 months into this phase. That means the window is measured in months, not years, not decades, months. But there's more to this exodus than treasury sales and gold purchases. There's an entire parallel financial infrastructure being built right now. Let me show you. While most Americans debate politics and scroll social media, an entirely separate financial system is being constructed. BRICS, originally Brazil, Russia, India, China, and South Africa, now expanded to include Egypt, Ethiopia, Iran, the United Arab Emirates, and Indonesia. 10 nations representing 45% of the world's population and 35% of global GDP. Their stated goal? Reduce dependence on the US dollar. At the October 2024 BRICS summit in Kazan, Russia, Vladimir Putin appeared on stage holding what looked like a prototype of a BRICS banknote. Representatives from over 30 additional countries attended. The UN Secretary General was there. 10 more nations were awarded partner status, including Turkey, Malaysia, Thailand, and Kazakhstan. This isn't a fringe movement. It's a coordinated effort by nearly half the world's population to build alternatives to dollar dominance. Let me show you what's already operational. China's cross-border interbank payment system, CIPS, now has 1,467 indirect participants across 119 countries. It links 4,800 banks in 185 countries. This system processes WAN-based transactions completely independent of SWIFT, the Western-controlled network that handles most international payments. SWIFT is how the United States enforces financial sanctions. When America froze Russian central bank assets after the Ukraine invasion, it demonstrated exactly why countries might want an alternative. If your reserves can be seized with a policy decision in Washington, those aren't really your reserves. Russia got the message. In 2024, Russia reported that 90% of its trade within the BRICS bloc was conducted in national currencies rather than dollars. Not 20%, not 50%, 90%. China and Russia now conduct most of their bilateral trade in yuan and rubles. That trade relationship hit a record $244.8 billion in 2024. Not a single dollar required. 8. Brazil and China signed a yuan real trade settlement agreement in 2023. India has begun purchasing Russian oil in rupees. The UAE and India completed their first crude oil transaction in local currencies in August 2023 through the Abu Dhabi National Oil Company and Indian Oil Corporation. These aren't proposals. These are completed transactions, operational systems, real money moving outside dollar channels. The renminbi is now reportedly used in 50% of all intra-BRICS trade. 5 years ago, that number was negligible. India has opened special Vostro accounts with banks in 22 countries, including Russia, the UK, Germany, Singapore, and New Zealand. These accounts allow trade settlement in rupees, bypassing the dollar entirely. The new development bank, the BRICS alternative to the World Bank, is targeting 1/3 of all loans denominated in member nations' local currencies by 2026. not dollars, local currencies. And it's not just trade, it's reserves. Central banks have been buying gold at historic rates. The shift away from dollar-denominated reserves into physical gold accelerated dramatically in 2022 and 2023. BRICS nations collectively control an estimated 50% of global gold production. They're not just buying gold, they're securing the supply chain. Until recently, nearly 100% of global oil trade was conducted in US dollars, the petrodollar system, the foundation of dollar demand since the 1970s. In 2023, 1/5 of oil trades were reportedly conducted in non-dollar currencies. Saudi Arabia has indicated willingness to accept yuan for oil sales. The exclusive grip the dollar held on energy markets is loosening. Now, let me be clear about what this is and what it isn't. The dollar still dominates. 88% of all foreign exchange transactions involve dollars. 59% of global foreign exchange reserves remain dollar denominated. The dollar's share has declined from around 85% in the 1970s, but it's still the foundation of global finance. A BRICS common currency remains more concept than reality. Brazil dropped the common currency proposal from its 2025 BRICS presidency agenda after Trump threatened 100% tariffs on any nation pursuing dollar alternatives. The political obstacles are enormous. India's foreign minister stated plainly in March 2025. I don't think there's any policy on our part to replace the dollar. The dollar, as the reserve currency, is the source of global economic stability. No country wants to crash the current system. They all hold dollars. A disorderly collapse would hurt everyone, but that's exactly how stage 3 works. It's not a sudden break. It's a gradual rotation. Slow enough that the system keeps functioning, fast enough that positions shift meaningfully over time. The Dutch didn't wake up one morning and decide to abandon Spain. They built Amsterdam over decades while still trading in reals. The British didn't abandon the guilder overnight. They developed London's financial infrastructure gradually while the Dutch system still functioned. And now, the world isn't abandoning the dollar overnight. They're building alternatives, testing systems, conducting transactions, accumulating gold, reducing exposure at the margins. The infrastructure for a post-dollar world is being constructed in plain sight. It's not ready yet, but it's being built. When stage 4 arrives, the exits will already exist. The question is, who will have positioned themselves to use them? Now, I know what some of you are thinking. America is different. We have the strongest military in history, the most advanced technology, the best universities, the most innovative companies, the deepest capital markets. This time won't be the same. Let me address that directly. Because if I'm wrong, you should know why. And if I'm right, you should understand why those objections don't hold. Objection 1, American military dominance protects the dollar. Spain had the most powerful military in the 1500s. The Spanish tercios were considered invincible. The Armada ruled the seas. They controlled half of Europe and territories across 3 continents. Didn't stop economic collapse. The Dutch had the most advanced navy of the 1600s. They controlled global shipping lanes. Their military technology was generations ahead of competitors. Didn't stop collapse. Britain had the largest empire in history. The Royal Navy dominated every ocean. Their military presence spanned a quarter of the planet. Didn't stop collapse. Military power doesn't prevent economic mathematics. You can't bomb your way out of compound interest. You can't invade your way out of debt spirals. When the fiscal foundation cracks, military strength becomes a cost you can no longer afford rather than an advantage you can leverage. Objection 2. The Federal Reserve can print unlimited money. They'll never let the system fail. They printed unlimited money in Weimar Germany. Hyperinflation destroyed the middle class. Savings became worthless. A wheelbarrow of cash couldn't buy a loaf of bread. They printed in Zimbabwe. They issued $100 trillion notes. Those notes became worthless faster than they could print new denominations. They printed in Venezuela. Inflation hit 1,000,000%. Doctors and lawyers worked as taxi drivers. People ate zoo animals to survive. They printed in Argentina. Multiple currency resets. Decades of poverty despite massive natural resources and educated population. Printing money doesn't create wealth. It redistributes it, from savers to debtors, from workers to asset holders, from the middle class to those who own hard assets. It works until confidence breaks. Then it accelerates the collapse rather than preventing it. Objection 3. There's no alternative to the dollar. This is the strongest argument. And it's partially true. The dollar still accounts for 88% of foreign exchange transactions, 59% of global reserves. No single currency comes close. The euro sits around 20%. The yuan is under 3%. The infrastructure of global finance is built on dollars. But here's what that argument misses. There didn't need to be a single alternative to the Spanish real. The transition to Dutch guilders happened gradually over decades. There didn't need to be a single alternative to the Dutch guilder. Capital flowed to London in stages, not all at once. Reserve currency transitions don't require a replacement to be ready on day one. They require confidence in the incumbent to erode past a tipping point. The alternatives emerge and strengthen as the decline progresses. BRICS isn't building a single replacement currency. They're building optionality, multiple currencies, multiple payment systems, multiple ways to transact that don't require dollars. The goal isn't to replace the dollar tomorrow. It's to reduce dependence gradually until the dollar's dominance becomes a choice rather than a necessity. And that process is already underway. Objection 4. America's debt is mostly held domestically. It's different from foreign-held debt. Japan's debt is over 230% of GDP, higher than America's. But roughly 90% of Japanese government bonds are held by Japanese institutions and citizens. When Japanese debt matures, it rolls over into Japanese hands. America is different. We depend on foreign buyers. Foreign governments hold over $8 trillion in Treasury securities. When China sells, someone else has to buy. When Japan reduces duration, demand has to come from somewhere. The more foreign holders reduce exposure, the more America has to rely on domestic buyers, or the Federal Reserve itself. That's the circular financing I mentioned earlier. Printing money to buy your own debt. Japan can sustain higher debt ratios because the money stays within their system. America's debt requires continuous confidence from creditors who have alternatives. Objection 5. BRICS will never succeed. They have too many internal conflicts. This is probably true in terms of a unified BRICS currency. China and India have border disputes. Russia is under Western sanctions. Brazil's economic priorities differ from the Gulf states. The political coordination required for a single currency may never materialize. But that's not the point. De-dollarization doesn't require BRICS to agree on everything. It requires them to agree on one thing, reducing dependence on a currency controlled by Washington. Russia and China don't need to love each other. They just need to trade in yuan and rubles. India doesn't need to join a currency union. They just need to buy oil and rupees. Brazil doesn't need political alignment with Iran. They just need settlement mechanisms that don't route through New York. The dollar's dominance wasn't built by a single agreement. It emerged from a web of bilateral relationships where using dollars was more convenient than alternatives. De-dollarization works the same way in reverse. One bilateral agreement at a time, one trade relationship at a time, one percentage point at a time. So where does this leave us? The dollar isn't collapsing tomorrow. Anyone who tells you it is doesn't understand the system. The infrastructure of global finance can't be rewired in months, but the trajectory has changed. The monopoly is eroding. The alternatives are being built. Foreign holders are reducing exposure. The pattern that preceded every previous reserve currency collapse is visible in the data. The question isn't whether America is immune to history. No empire has ever been immune to history. The question is timing, and what stage 4 looks like when it arrives. And based on the pattern, based on history, based on what happened every previous time. This is what stage 4 looks like. It doesn't start with a single announcement. No president walks to a podium and declares the dollar is no longer the reserve currency. That's not how it works. It starts with acceleration of what's already happening. Foreign central banks that were reducing treasury holdings by small percentages, each quarter start reducing by larger percentages. The selling becomes visible in the data. Yields rise because there are fewer buyers for the same amount of debt. The Federal Reserve faces an impossible choice. Option 1. Let interest rates rise to whatever level attracts enough buyers for $2 trillion in annual deficits, plus refinancing of maturing debt. If that rate is 7%, 8%, 10%, so be it. But at those rates, interest payments on $38 trillion in debt become genuinely unpayable. At 7%, interest alone would consume $2.7 trillion annually, more than Social Security, more than Medicare, more than defense, combined. The entire federal budget becomes interest payments plus a few essential programs. Everything else gets cut, or the deficit explodes further, requiring more borrowing, pushing rates higher, requiring more borrowing. A death spiral. Option 2. The Federal Reserve intervenes, prints money to buy treasuries, keeps rates artificially suppressed by becoming the buyer of last resort. But that money doesn't disappear. It enters the economy. More dollars chasing the same goods. Inflation that's already been running hot goes vertical. And here's the critical mechanism most people miss. There are trillions of dollars held overseas. Foreign central bank reserves, corporate accounts, sovereign wealth funds, private wealth, all denominated in dollars because the dollar has been the safest store of value for 80 years. When confidence cracks, those dollars come home, not because foreigners are attacking America, because they're protecting themselves, converting dollar holdings into their own currencies, into euros, into gold, into real assets, into anything that isn't tied to a declining reserve currency. That flood of dollars returning to American shores is inflationary in a way most people have never experienced. It's not demand-pull inflation from a strong economy. It's currency debasement. The same number of dollars buys less because there are suddenly far more of them circulating domestically. Weimar Germany, Zimbabwe, Venezuela, Argentina. The mechanism is identical every time. When a currency loses reserve status, the overseas holdings return and purchasing power collapses. What happened to asset prices in previous Stage 4 collapses? Everything deflated simultaneously. Stocks, bonds, real estate. Every asset class that had been inflated by easy credit and foreign capital inflows reversed. In Spain, the merchant class was wiped out. Productive businesses closed. Wealth that had accumulated over generations evaporated. The commercial houses at Cadiz fell into foreign hands. In the Dutch Republic, the Bank of Amsterdam's collapse revealed that depositors' money had been lent out and lost. Real estate that had boomed during the Golden Age crashed. The rentier class that had lived on interest payments found their income streams worthless. In Britain, the 1949 devaluation destroyed 30% of international purchasing power overnight. The 1967 devaluation took another 14%. Families who had saved in pounds watched their wealth erode over decades. The middle class that had been the backbone of the empire found themselves struggling in ways their grandparents never imagined. The pattern predicts simultaneous failures across systems that people assumed were independent. Banks fail because their assets lose value faster than their liabilities. Pension funds go insolvent because their projected returns assumed stable currency and positive real interest rates. Insurance companies collapse because their reserves can't cover claims denominated in a weakening currency. The cascade is self-reinforcing. Each failure creates pressure on connected institutions. Credit markets freeze because nobody knows which counterparty is solvent. Economic activity stalls because transactions require trust that no longer exists. Then comes political chaos. Spain saw its empire fragment and its influence collapse for centuries. The Dutch Republic was invaded and occupied. Britain lost its empire, faced domestic unrest, and required external bailouts. Economic crises of this magnitude don't stay economic. They become social, political, sometimes violent. The institutions that depend on public trust lose that trust precisely when they're needed most. How long does Stage 4 last? The acute phase, the period of maximum disruption, typically runs 18 to 36 months based on historical precedent. The aftermath lasts much longer. Spain never recovered its position. The Netherlands became a small, prosperous country, but never again dominated global finance. Britain spent decades adjusting to diminished status. The question everyone asks afterward, how did we not see this coming? The answer is always the same. The data was public. The pattern was visible. The warning signs were documented. But people didn't want to believe it. They assumed their empire was different. They assumed their currency was permanent. They assumed the trajectory that had worked for their entire lives would continue working. They were wrong. Every time. The mathematics of debt, the psychology of confidence, the mechanics of currency collapse, these don't change because technology advances or because military power exists or because people believe hard enough in exceptionalism. The pattern doesn't need your faith. It doesn't require consensus. It doesn't wait for permission. It just unfolds. Like clockwork, like mathematics, like gravity. The historical timeline suggests we're somewhere in the middle of Stage 3, perhaps 12 to 18 months in based on when foreign selling accelerated and alternative systems began operating. That means Stage 4 could begin in months, could be a year, could be longer if some external factor delays the timeline. But the trajectory is set. The pattern is in motion. The only variable is timing. So what do you do with this information? What they did differently from those who lost everything. What the pattern suggests matters when Stage 4 arrives. First, concentration kills. If most of your wealth is in dollar-denominated assets, you're exposed to a single point of failure. Bank accounts, bonds, stocks priced in dollars, real estate mortgaged in dollars, retirement accounts invested in dollar assets. That's not diversification. That's concentration with different labels. The families who preserved wealth through Spain's collapse held assets across jurisdictions. The merchants who survived Amsterdam's fall had already established operations in London. The British industrialists, who saw the writing on the wall, had diversified into American markets before 1945. Diversification means exposure to assets that don't all move together when confidence in one currency breaks. Second, real assets have survived every currency collapse in history. Gold has held value for 5,000 years across every civilization. Not because of tradition, because it can't be printed, can't be debased by central bank policy, can't be created by government decree. Silver, commodities, productive land, assets that exist independent of any government's promises. When Spain debased the vellon, gold held value. When the guilder collapsed, real assets remained. When the pound lost 75% of its purchasing power over a century, hard assets preserved wealth. This isn't about becoming a gold bug or a doomsday prepper. It's about having some portion of your wealth in assets that don't depend on continued confidence in any single currency. Third, geography matters. The smart money in every historical transition moved across borders, not because they were unpatriotic, because they understood that political risk and currency risk and economic risk often concentrate in the same geography. Research jurisdictions with stable legal systems, strong property rights, different currency exposures, lower debt levels, political neutrality. This doesn't mean moving to another country. It means considering whether 100% of your assets should be subject to the decisions of a single government, regardless of which government that is. Fourth, debt is a trap in stage 4. When interest rates spike, debt becomes dramatically more expensive to service. Variable rate mortgages, credit card balances, business loans with floating rates, all of them adjust upward. High leverage in a rising rate environment is financial suicide. The people who get destroyed in currency crises are often those who borrowed heavily when money was cheap and couldn't service that debt when conditions changed. If you're carrying significant debt, consider reducing it while rates are still manageable. Fifth, liquidity provides options. Cash loses value to inflation. That's true. But in a crisis, liquidity gives you options that illiquid assets don't. And when asset prices crash, those with cash can buy. When opportunities appear suddenly, those with liquidity can act. When emergencies strike, those with accessible funds can respond. The goal isn't hoarding cash. It's maintaining enough liquidity to navigate disruption without being forced to sell assets at the worst possible moment. Sixth, skills and relationships are the ultimate hedge. Every form of wealth can be devalued, confiscated, or destroyed by circumstances beyond your control. Except one, human capital, what you know, what you can do, who you trust, and who trusts you. The doctors and engineers and skilled tradespeople in Weimar Germany could still earn a living after the currency collapsed. The people with valuable skills in Venezuela found ways to survive when others couldn't. Knowledge that solves problems retains value regardless of what currency it's denominated in. Invest in yourself. Build skills that create value. Develop relationships with people you can count on when systems fail. Seventh, information is the differentiator. The people who survived these transitions weren't always the wealthiest. They were the ones who understood what was happening before everyone else did. They read the data. They recognized the pattern. They acted while others were still debating whether there was a problem. By the time the crisis is obvious, the best options are gone. The time to position is before the crowd arrives at the same conclusion. You're watching this video. You now know the pattern. You've seen the historical precedents. You understand what the data is showing. What you do with that information is up to you. Let me bring this full circle. $38.4 trillion in debt, $970 billion in annual interest payments, debt growing at $70,000 per second, the fastest accumulation of $1 trillion outside of a pandemic. These aren't projections. These are the numbers sitting on the Treasury Department's books right now. And those numbers follow a pattern we've now traced across 500 years and 3 global superpowers. Spain, the most powerful empire of the 1500s. Reserve currency status, military dominance, wealth beyond imagination, 4 stages, collapse, the Dutch Republic. The richest nation of the 1600s, financial innovation, global trade networks, the guilder as the world's money, 4 stages, collapse. The British Empire, the sun never sets. 200 years of sterling dominance, a quarter of the planet under one flag, 4 stages, collapse, same sequence, same warning signs, same outcome, every time. America entered stage 1 in 1944. Stage 2 began in 1971 when Nixon closed the gold window. The debt explosion that followed, the asset bubbles, the money printing, all of it matches the historical pattern precisely. And now, the evidence for stage 3 is accumulating. China's treasury holdings down 47% from peak. Foreign central banks accumulating gold at historic rates. BRICS nations conducting 90% of internal trade in local currencies. Alternative payment systems operational and expanding. $244 billion in China-Russia trade without a single dollar. The smart money is moving. The infrastructure for a post-dollar world is being built. The exodus is underway. Stage 4 is coming. The mathematics are inevitable. The pattern doesn't care about politics or military power or technological innovation. It just unfolds. The only question is whether you'll be positioned correctly when it hits. I want to hear from you. Drop a comment below. Tell me what you think. Where do you disagree? What questions do you have? What are you doing to prepare? I read every single comment, and I'll address the best questions in future videos. If this video opened your eyes to something you hadn't considered before, share it with someone who needs to see it. This information shouldn't stay hidden in algorithm feeds. The more people who understand the pattern, the more people can protect themselves. And if you're not subscribed yet, now is the time. Hit subscribe. Hit the bell for notifications. Because the next video reveals something I couldn't fit into this one. Which specific assets performed best during historical stage 4 collapses? What happened to gold when Britain's pound collapsed? What happened to real estate during Spain's defaults? Which sectors preserved wealth through currency crises and which ones got destroyed? The pattern doesn't just predict collapse. It predicts which assets survive and which don't. That video is coming soon. You don't want to miss it. The pattern is real, the data is verifiable, the history is documented. 3 empires thought they were different. 3 reserve currencies seemed permanent. 3 populations assumed their prosperity would continue indefinitely. They were wrong. The people who preserved wealth through those transitions weren't the richest. They weren't the most powerful. They weren't the most connected. They were the ones with the best information. And the courage to act on it before everyone else reached the same conclusion? You now have the information. What you do next is up to you. See you in the next one.